In Canada, almost anyone can call themselves a financial advisor. There's no single licensing requirement, no protected title, and no guarantee that the person managing your money is legally required to act in your best interest. That's not a scare tactic. It's just the reality of the Canadian financial industry. And it means that choosing the right person to help manage your finances, if you decide you want professional help, requires knowing exactly what to look for and what to avoid. Today, we're covering everything you need to know. Unlike the title doctor or lawyer, the term financial advisor is not legally protected in most Canadian provinces. Someone with minimal training and primarily motivated by product commissions can legally call themselves a financial advisor. The titles that do carry meaningful weight are more specific. A certified financial planner, CFP, has completed rigorous education, passed a comprehensive exam, and is held to professional standards by FP Canada. This is the most recognized planning credential in the country. A Chartered Financial Analyst, CFA, is a globally recognized credential focused on investment analysis and portfolio management. A Registered Financial Planner, RFP, is another credible planning designation. When looking for financial help, look for these specific designations after someone's name rather than the generic financial advisor title. The credential tells you they've met a real standard. How a financial advisor gets paid is the single most important thing to understand, because the fee structure shapes every recommendation they make. Commission-based advisors earn money when you buy financial products. Mutual funds, insurance products, and certain investment accounts pay the advisor a commission, often built invisibly into the product's fees. The problem is obvious. An advisor who earns more when you buy product A than product B has a financial incentive to recommend product A, whether or not it's better for you. This is why, as mentioned in a previous video, actively managed mutual funds in Canada carry management expense ratios, MERs, of 2 to 2.5% per year. A significant portion of that fee flows back to the advisor who sold you the fund. On a $200,000 portfolio, that's $4,000 to $5,000 per year coming out of your returns, year after year, compounded over decades. Fee-only advisors charge you directly, by the hour, by the project, or as a percentage of assets under management, and don't earn commissions on products. This removes the conflict of interest. A fee-only advisor recommending a low-cost ETF portfolio earns the same as one recommending an expensive mutual fund. So their incentive is to give you the best advice, not the most profitable product. Fiduciary advisors are legally required to act in your best interest at all times. Not all Canadian advisors are fiduciaries, and this is a critical distinction. Ask directly, are you a fiduciary? Are you legally required to act in my best interest? The answer will tell you a lot. Here's an honest take. For many Canadians, especially those just starting out, you don't need a financial advisor at all. As covered throughout this channel, opening a TFSA, buying a single all-in-one ETF like XEQT, setting up automatic contributions, and leaving it alone is a genuinely excellent investment strategy. It will outperform the vast majority of actively managed portfolios over 20 years. You don't need to pay someone 1 to 2% of your assets annually for that. Where a good financial advisor adds real value is in more complex situations. Tax planning for high-income earners or business owners. Estate planning, navigating a significant life event like an inheritance or divorce. Optimizing CPP and OAS timing in retirement, or coordinating multiple accounts and income sources in a way that minimizes lifetime taxes. If you're in one of those situations, a fee-only CFP charging $200 to $300 per hour for a one-time financial plan is often money very well spent. You get expert advice without an ongoing fee eating your portfolio. The resource to find fee-only advisors in Canada is the Advice Only Network, a directory of Canadian planners who don't sell products and charge transparent fees. It's a good starting point if you decide you want professional guidance. Here's the summary. Look for CFP or CFA credentials, not just the generic advisor title. Understand how your advisor is paid before you trust their advice. Ask directly if they are a fiduciary. And be honest with yourself about whether you actually need ongoing advice or just a one-time plan. Most Canadians with straightforward finances, a TFSA, an RRSP, some ETFs, maybe a mortgage, can manage their own money effectively with the knowledge covered on this channel. Professional advice is valuable when your situation genuinely requires it, not as a default. Next week, we're covering something that will affect every Canadian worker at some point. What to actually do with your finances when you change jobs. Old pension, group RRSP, new benefits package. There are real decisions to make and some costly mistakes to avoid. Subscribe and I'll see you there. See you then.